Hello everyone, welcome back. In this video, I'm going to be explaining the ICT breakaway gap. Understanding this very simple concept will improve your trading immensely. One of the skills you'll be getting after this video is how to read price using the fair value gap. That stated, before we move forward, we will need to understand what the fair value gap is. A fair value gap is one-sided price delivery to either the buy side or the sell side. The fair value gap has to do with three candles. It's the gap between the first candle and the third candle. So this gap here is what we call the fair value gap. So for a bullish move, it's called a BC, buy side imbalance, sell side inefficiency. And then for a bearish market, it's called what? A CB. That's sell side imbalance, buy side inefficiency. Okay, now, once price creates a fair value gap, it is an evidence of displacement. And whenever we see displacement in a particular direction, is a telltale sign that price wants to continue going in that direction. It shows momentum. If price should retrace back to that fair value gap which was created, we expect that price would find support before continuing the trade. And for a bearish market, the reverse is the same. If price should retrace back into the fair value gap which was created, in this case a CB, price should find resistance to continue going lower. So this creates an opportunity for us to enter a trade. Now, moving forward, I'll need to point your attention to the fact that not all fair value gaps get filled as price runs for liquidity, and these gaps are called the breakaway gap. Now, usually every area of inefficiency gets filled, but when you talk about the breakaway gap, it all has to do with timing. When does it get filled? Before moving forward, I still need to explain one more concept, the institutional order flow, so we can get a better understanding of how the breakaway gap relates with time. So what's the institutional order flow? The institutional order flow states that if price is bullish, that is, if institutional order flow is bullish, every bullish institutional level will serve as support for price to continue going higher. Let me give an example. Let's say market is running for a liquidity above price here, and this is where price currently is. Now, once it expands higher, usually it leaves what? The fair value gap or another block here. Okay. If it retraces these institutional levels, because these are bullish institutional levels, this is a fair value gap and then another block, should serve as support for price to continue going higher. And as it expands again, this leg here may leave a fair value gap or another order block here, or even a breaker block or a mitigation block. If price should return, either of these areas should serve as support for price to continue going higher. So each institutional levels, as price retraces, should serve as support as market keeps going higher. So when you open your chart and you see that every fair value gap is being respected, every bullish order block, every bullish breaker block is being respected as price rallies higher, it's a telltale sign that the institutional order flow is bullish. Price will continue to rally higher in that manner until the objective is achieved. Most times you see how price will run in this manner until either a buy side liquidity has been taken or a higher time frame area of inefficiency has been filled up before you start seeing price running lower. So let's go to the chart so I can explain better with an example. So here's Euro USD. This is the 1 hour time frame. Just for the sake of time, let's assume that from your analysis, you're able to predict that price will run from this low to this high, taking out the buy side liquidity. So this buy side liquidity is our objective, our drawn liquidity. Now, as soon as price starts running from this point, you notice that it left what? A fair value gap, right? There's a fair value gap here of which price filled up, found support, rallied. When it retraced again, what do we have here? We have what? A bullish order block. Price found support, rallied. On doing that, it left what? Another fair value gap. All right. Price came back, found support like this, 1, 2, and then boom, took out this high. All right. So our objective has been met. As soon as this objective was met, you will note that we have another order block here. As price was coming down, it disrespected it. It did not find support here. So if institutional order flow, if it's bullish, every bullish institutional level will hold price as it rallies higher until the objective is achieved. And the reverse is the same for a bearish market. Every bearish institutional level will serve as resistance to price as price retraces until the objective is achieved. So when you keep seeing price respecting institutional levels, it's a telltale sign that institutional order flow is in play in whatever direction the price is moving. All right, let's get back to the slide. At this point, I would like to say that the breakaway gap is most relevant when applied with the institutional order flow because most times price creates area of inefficiencies, but they don't get filled immediately. They can get filled later on in the future. But let's say you are taking a trade and you're trading from point A to point B. Each fair value gap that has been formed is actually relevant because you're anticipating that if it returns back, you could be entering or re-entering if you're already in a trade. But if price creates a fair value gap and price did not return back to that fair value gap, that is if it's bullish, then we call that what? A breakaway gap. And I will say it again, it doesn't mean that this fair value gap will not be filled later on in the future. We are only using it based on the context of institutional order flow at that time. Okay, so here's an example. This is a fair value gap. Remember, it's formed by three candles. We have one, two, three. And you can see this gap here, which was created between the first candle and the third candle. As price fell, it left this gap open, but created another fair value gap, of which it used as resistance to continue going lower, running forward the sell side liquidity. So this gap that was left open is what we call the breakaway gap. The breakaway gap mostly occurs when a fair value gap is formed as price, one, breaks through a swing high or low. Secondly, leaves an area of consolidation with a clear directional bias. Breakaway gaps, usually when you see them in your chart, it denotes speed and momentum. It's telling you that price is in a hurry to get to a particular level in price. So if you're in a trade, you actually want to see breakaway gaps because it's telling you that price is moving very fast to liquidity. But if you keep seeing price retracing, going high, retracing, most times it could affect your trade, especially if you move your stop loss to break even. You would see that price will take you out and then keep going in that direction. But when you see price leaving gaps, going higher or going lower, it's what you want to see. It's telling that price is in a hurry to that area of liquidity. And once that liquidity is purged, usually you would see price return back to fill that area of inefficiency and less likely continue in that direction it was moving prior. So the breakaway gap usually occurs when a fair value gap is formed as price breaks through a swing high or leaves an area of consolidation. Usually when a fair value gap becomes a breakaway gap is when you see price breaking away from consolidation or breaking a swing high or low. So like the name, breakaway gap, when it breaks away. But most times you see this occur. Now I need you all to pay good attention to what I'm about to say. We do not expect price to fill the breakaway gap. If price does return to this breakaway gap, the probability of finding support or resistance at that fair value gap decreases. What does that mean? Now, once you see price create a breakaway gap like we see here, if price should return back to that breakaway gap, it reduces the probability of price continuing the initial trend. And that's why we need to understand breakaway gaps in order to read price. So breakaway gaps are not used for entries. Instead, they are used to read price. They are used to measure the momentum of price movement. All right. So if you see price create breakaway gaps like we see here, we want to see those gaps open. If those gaps remain open, it tells you the strength in momentum as price runs for that liquidity. It could either be above or below. So now let's go to the chart so we can see how we can use the breakaway gap to read price. Here, I would like to reiterate that every ICT concept must be used with context. You don't want to just use it alone. You want to see them as tools that you can apply to your trading and not just pick one and use it alone. Although you don't have to use everything at once. We can pick a few and then use them to build context in reading price. All right, so now applying the breakaway gap doesn't mean you just look for any gap that you think will be left open and then don't expect price to get there and you move your stop loss to that point. No, you don't just do that. First of all, you want to determine your bias. You want to know where price is going. Remember, order flow remains bullish or bearish until the objective is met. So once the objective is met, then there is room for reorder or a change in order flow. All right, so we're going to be studying this day. So I think I'll just take it out now. This is Friday, just yesterday. Now, when you analyze the chart from a daily time frame, if you're a day trader or a scalper, the most likely place price is going to run for, or the most likely drawn liquidity is the previous daily high and previous daily low. All right. And that's what forms the next day model. So if you look at what happened here, the previous daily low was taken, this candle here took out what the previous daily low and kept going lower. It even closed below the previous daily low, telling you that the next candle is most likely to run forward the previous daily low. Here, I can see that happened. All right. But when we see a rejection, it's a telltale sign that price is running for the opposite liquidity. So let me show you an example. You can see here, price ran the previous daily high and then rejected. It didn't close outside the previous daily high. What happened? The next day, price ran forward the previous daily low. So it's not perfect. It doesn't mean that if price runs for the previous daily low, then we want to expect the next day to run forward the previous daily low. It might not happen, but it just serves like a compass to direct you on the most likely run on liquidity. So you can see here, price has taken what the previous daily high, it reversed. It didn't take the previous daily low here. Instead, it took what the previous daily high. So I think I should take all this out so we can get a better view of the price. So price took what the previous daily high. Okay, so where do you think price is most likely to go? This previous daily high here is my next strong liquidity. So I'm expecting a bullish day. Now, it may not be an up close candle. It may actually be a down close candle, but I'm expecting an expansion higher. Then the second thing is we can see a three candle pattern here being formed. This is a swing low. When we have a three candle pattern, the next candle is most likely to go in that direction. So we have a swing low here. So the fourth candle, even down to the sixth candle, is most likely to be bullish. An example here, you can see we have a swing high. We have one, two, three. Why is it a swing high? The candle at the middle is higher than both candles at the left and the right. So we're expecting that the next candle, that is the fourth candle to be formed, will be bearish. And then we can see something like that here. We have one, two, three, swing high, the fourth candle bearish. We can see another one here. One, two, three. This is a swing low. All right. The fourth candle was what? Bullish, even down to the sixth candle. Even though we have a down close candle here, we could see an expansion. This like this. Here is a trade you can take, you can buy on this day and still make money. Okay, so now the next day we're anticipating this day to be bullish, and that's what we got here. We already know that this high is our drawn liquidity. So let's go to our 4-hour time frame. Okay, so now here's our 4-hour time frame, and you can see price finding support at a 4-hour order block, all right, which supports our bias. We want to see price find support here. We can see a fair value gap as well. Price is filling an area of inefficiency. You can see how price ran for this high. So go to the 1-hour time frame. All right, if you look closely, you could see we have what? Down close candles, consecutively down close candles with an area of inefficiency. You can see our price came back down to find support and is running higher. Above, you can see relatively equal highs, which is a very, very strong draw on liquidity. Now we'll go to the 15-minute time frame. Here we can see a market shift as price found support at this level, this 4-hour order block. So you can see a shift, price broke this high, came back down on a rally. We can also see a change in state of delivery. This is a down close candle, a 15-minute order block. You can see this candle closed above it, found support and a rally. So I don't trade gold London. I trade gold at the New York session because why? It is paired with the US dollar. All right. And the US dollar is most volatile at the New York session. Okay. So this is the New York session. All right. You can see at this Q zone, price created what? Consecutively down close candles. And then this candle here closed above the open price, which confirms what? Our change in state of delivery. And immediately we can see this candle here. It returned to find support and it rallied. So we're going to go down to the 1-minute time frame and study the breakaway gap and how we can use it to read price. All right. So remember, this is our drawn liquidity. I think I should just color it orange. Yeah, orange. Now, this is our 15-minute order block. You can see as price came back down to find support, it did what? Created consecutively down close candles. And then here we have a confirmed change instead of delivery as this candle closed above this open price. So you could be entering here, this candle here retraced down, found support, and then boom. Now, as price expanded higher, you can see it left what? Fair value gaps. And these fair value gaps remain open. So these gaps are breakaway gaps. When we see something like this, we don't want to see price return back to it after moving like this. Now, it doesn't mean it can't retrace like we see here, find support and rally. Because if price should find support at this fair value gap, okay, break above this high and start coming down after leaving this fair value gap, the probability that price will keep going higher reduces. A second thing I want to note is that Partially filled fair value gap are also breakaway gaps. That is, the part that was not filled by price is also a breakaway gap. So after seeing price filling this area or this portion, now we know that the fair value gap starts from here. Remember, it's three candles, black. This is the fair value gap, but this was the portion, this blue shaded area was the portion that was filled by price, and then left this orange area open. Now, this orange area is a breakaway gap. As soon as price breaks out and takes this high, this becomes a breakaway gap. We do not want to see price return back to this level. Now, it might happen, but if it happens, the probability of price continuing going higher reduces. All right. Now we see another fair value gap here. Okay. Price consolidated and then broke higher. It did not fill this fair value gap. Once it breaks higher, breaking this high, this becomes what? A breakaway gap. And we don't want to see price come back here. All right, you can see here again, this huge movement. These are breakaway gap. This is momentum, guys. When you see price creating multiple breakaway gaps, it's price saying, I want to get to liquidity fast. So now we have another fair value gap here. I think I should just draw it out. You can see the fair value gap. Price returned back to it here and then rallied higher. All right, this is when we have a large expanded candle creating a huge fair value gap and then price just dipping into it a little bit to continue going higher. Now, this other portion here, like we can see here, this other portion here, which price did not fill, okay, is what we call what? Breakaway gap. Now, you will note that as soon as price comes back here, found support, rallied, broke this high, it came back down to this breakaway gap. As it came back down, you will note that price did not go higher. Price kept falling, kept tanking, and then filling in all these areas of inefficiency. You can see price kept coming down. And usually we get to see this when the objective has been met. So the institutional order flow here, which was bullish, has ended because the objective has been achieved. So we use breakaway gaps to tell when price is most likely to reverse, if a trend is still going to continue, and also most likely places to move our stops and to add positions. Now, say for instance, guys, this is more advanced, all right? Take for instance, you see something like this, leaving this breakaway gap, and you entered here. You can move your stop here, even entering again, all right? Using this breakaway candle. As this candle breaks this high, you can be adding to your position with your stop here. And as price keeps going higher, you keep trailing your stop using the breakaway gap. And then you can as well leave your stop here as price keeps creating this breakaway gap. All right. Probably you may have another target here. And that target here, let's still color it orange. But price only hits this target. And then you see that it starts coming back down to the breakaway gaps which were created here. It will let you know that, oh, this institutional order flow has achieved its aim and has come to an end. So I think I should take my partials or I should completely close the trade. So this is how you use it to read price. You don't use it for entries, you use it to read price, guys. So therefore, the big question would be, how can I tell a fair value gap is going to be a breakaway gap even before it's formed? All right, let me show you guys. How do you know when an FVG is likely a breakaway gap? It comes down to institutional order flow and momentum. So here are the few key characteristics you need to know. When a fair value gap forms with a high momentum expansion, that is when you see a huge expansion like this, most likely that's going to be a breakaway gap. The presence of a mitigation block or a breaker block. All right, so a breaker block is when price forms something like this. Okay, so you could see that price took out liquidity and then broke this high. So when it's returning, this candle here will be a breakaway gap. And the reverse is the same for a market like this. So you can see price took out liquidity, broke structure, returned, came back down to find resistance. So when you see a breaker here and there's a fair value gap here, most likely price will use the breaker for resistance instead of going all the way back to that fair value gap. So you want to treat that fair value gap as a breakaway gap. Don't worry, guys, I'm going to explain further in next slides I'm going to be showing. Then the third is alignment with an FVG on a lower time frame. So let's say on a 3-minute time frame, there's an open gap, but if you go to a 1-minute time frame, that gap has been filled. The last is when there are multiple fair value gaps, but price typically respects and fills only the most recent fair value gap. leaving older imbalances untouched as it breaks a key swing high or low, showing continuation in strength. So if you have multiple fair value gaps here, 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 and then the most recent fair value gap, just like we saw in the chart, price rebalanced it and then continue going higher, these fair value gaps will most likely be what? Breakaway gaps. Now, this sign suggests price is prioritizing liquidity over rebalancing, increasing the likelihood of a breakaway gap. So let's look at them one after the other. So when price creates a huge expansion like this, let's say the news was released or something happened, usually that gap becomes a breakaway gap. Usually price might return back into it like a little dip, then continue going lower. So we call this institutional order flow entry. We're telling you that price is in a hurry to get to that area of liquidity. So when you see huge gaps like this, just treat it as a breakaway gap. If price leaves it, we do not anticipate any return back into it until the objective is achieved. But if it starts going back there, it's most likely the objective has already been achieved and the chances of price continue going lower will reduce. Then the next is when you have a breaker block, okay? ICT institutional levels have a hierarchy. Here there are. So for the premium, we have the old high or low, rejection block, bearish order block, fair value gap, liquidity voids, bearish breaker, and then the mitigation block. So if you open your chart and you see a mitigation block and the fair value gap, you choose to use the mitigation block for an area of resistance or support. All right, so as it goes higher, you start with the one below. So the mitigation block comes first before the breaker, then the breaker comes first before liquidity void, then it also comes first before fair value gap. So you can see that fair value gap is high above. So when you see a breaker block like this and the fair value gap below, expect that that fair value gap will most likely be a breaker gap. Now, it doesn't mean that price cannot dip into it. That can happen. But once you see price finding support or the breaker block with a fair value gap below, and then expanding higher, you want to treat that fair value gap below the breaker block as a breakaway gap. All right. So now when you have a fair value gap in a higher time frame, and then you move one step down in that time frame, and you see that that fair value gap was already filled and price has moved away from it, you want to treat that fair value gap as a breakaway gap, just like we see it. So here's a 3-minute time frame. This is a 1-minute time frame. This same fair value gap, all right, is the same one here. And you can see in the 1-minute time frame, it has been filled. And you can see in the 3-minute time frame, it wasn't filled. All right, so you want to treat it as a breakaway gap because in one step down in time frame, price has filled it. So when you see something like this, you want to treat that as a breakaway gap. Now, and then the last way to know is if price creates multiple fair value gaps, all right, and then fills just the most recent fair value gap and expands higher or lower, whichever direction, leaving these fair value gaps open. You want to treat them what as breakaway fair value gaps. So once you see price expanding away after filling the most recent fair value gap, all right, and start coming lower again, already it's a telltale sign that most likely the objective above has been achieved, and then the institutional order flow has changed for that time being. Probably price is retracing back down to a higher time frame support level to begin another bullish institutional level, of which every fair value gap will hold price, breaker block, mitigation block as price keeps going higher until the objective is achieved. All right, I hope this was helpful. Please, if you enjoyed this video, give it a thumbs up. And if you want to get more videos from this channel, please do subscribe. All right, guys, see you next week.